Hey guys, welcome back to the Results Junkies podcast. Coming to you live, in tape delay from the Fontainebleau Resort in Las Vegas, Nevada. Mr. Singh, looks like you are sitting at home this week. It's a little bit warm out in Vegas this week. How are you doing?
I'm good, man. It's hot. This week's been hot. Probably just as hot as Vegas, but we got the warm embrace of high humidity as well. So
Yeah, just a little bit of humidity out there in Northern Virginia. So we're going to pick up where we left off last week, and we're going to talk a little bit about how companies are raising right now and what we're seeing that's different. And if we get a little bit of time after that, we're going to talk about car insurance, something that nobody ever talks about from an exciting standpoint.
I think it's interesting.
It is. Just a little bit of housekeeping. show@resultsjunkies.com is how you shoot us an email with your questions or comments. You can also find us on social media. I am at Ed Pizza, a Pizza in Motion on all those social media channels. He is at Paul Singh. So let's get into this article about fundraising, and it started with, this specific article mentions Y Combinator, but I'll also note that I've been seeing more of this, here and there as companies have been approaching us. And so the general gist of the article is that a number of companies coming out of the latest YC class were raising smaller round than normal, but that the valuations were trending a bit higher than, say, the rest of the market is. Now, we're not talking anything like, lofty 2021 days for valuations, but maybe not quite a micro raise, but, probably half of what you'd normally see founders raise, and at a valuation that's, probably 30 to 50% higher than maybe where the rest of the market is right now. I certainly have some thoughts, but I'm curious where your head is on this trend, and if you've been seeing it and what you think about it for companies that are raising money.
This is one of those topics where I have to answer it from both sides of the coin. First, as a founder and entrepreneur, I think it is super smart what the companies are doing. They're by raising less, you keep your early exit options open. You own more of the company. It's from a founder standpoint, if you can do it, you should do it. And I think it speaks volumes of like sort of the YC momentum that it brings to any deal, right? Their initial check size is pretty massive relative to other accelerators, and then their ability to, essentially influence the market to be able to get great deals like this is great as a founder. It sort of just proves why, as a founder, you should do whatever it takes to get into YC. On the investor side, it's the opposite. It's kind of, you're damned if you do, you're damned if you don't. If you don't participate, you miss all the potential upside. If you badmouth them, they're a large enough group where YC can essentially make sure you don't see any more deal flow. And if you do the deal, you're kind of at the mercy of the founders. Like, a lot of the safe notes, for example, don't have a lot of the same protections in certain edge cases that more traditional equity documents or convertible note documents have. So yeah, I mean, the summary of both sides of that, though, is that YC has sort of really, really tipped the market in terms of making it founder friendly and beneficial mostly to themselves. So I definitely have more thoughts, but let me pause there. What are you thinking?
Yeah, so I have only good thoughts about this. I guess, this is where you and I wouldn't say differ per se, but you have so much experience in how many startups you've invested over the years, and this philosophy of having to make sure that you're really, taking every chance you can to invest in your winners as they hit follow-on round after follow-on round after follow-on round. And I would say that, over the course of the time that we've been investing, I would say somewhere between 6 and 8 years is the average exit of the companies that are, getting to some sort of monetization event. And we've had a few that have exited early for whatever reason. And generally speaking, it was, for a lower amount than maybe we had hoped, but they exited. You commented on the fact that this is founder friendly, and I agree. And I think for two reasons. First, I obviously agree with your reason that this gives them the optionality to exit earlier. Like, I think we talked about this sort of off the show with, Julian from PointsPath and what his potential path might be to an exit. And, if he goes out there and raises $2 or $3 million, he's got to outrun his preference stack to make sure that he can get paid. And, if the preference stack is $250,000 versus $2.5 million, it's a lot easier to outrun that preference stack. So there's that piece. The other thing is that, and you and I have talked about this on the show a number of times, I mean, late stage funding has changed fundamentally over the past couple of years. And in many cases, it's a lot harder to raise that round. And so if you're raising small and giving yourself the option to exit earlier, you're putting yourself in a position to for a couple things. First off, you're putting yourself in a position to obviously be able to monetize before you run out of cash. But I also think that if you're trying to raise a second round and a third round and you're going out there, I think you're probably going to give yourself more total options if your second raise doesn't have to be 6, 8, 10 million. If your next raise is $1 million or $2 million, some companies might even still see that in the quote unquote seed world and be willing to write a larger check into it. So I'm definitely pro these smaller raises for sure, even if I might end up with a little bit less of the company. To your, for your experience in terms of the long haul of this stuff, lower value exits really would make me have to think about what the IRR looks like on a portfolio. And so maybe I'm thinking about it from a naive perspective, but at first blush, it feels like smart people can make money in this formula.
I think they can. Let me preface this. Let me preface my next set of statements with something that I think is obvious, but not routinely mentioned, I think, which is that there are lots of ways to make money in startups. There are certainly a lot more ways let me rephrase. Losing money in startups is relatively easy. But making money in startups as an investor, there are more than a few ways to do it, as long as you're being thoughtful about it. And I'll just kind of maybe just use a very high level example to explain the nuance, and then maybe kind of answer the comment/question here. So high level nuance here is that most people, I mean, you just look at that article that we're referencing here. The investor that they interviewed said something along the lines of, it was very hard to get double-digit ownership percentages. And so that is a very common line of thinking in the investor community about figuring out what target percentage you want to own. Now, I'm not suggesting that's wrong, but what I am saying is that if that's the strategy, then you got to go all in on it. You got to make sure that every deal hits your minimum holding or percentage requirement. And as long as you build the entire portfolio that way, you're mitigating a lot of the potential risk that comes with not doing that. And so what I call that is that's sort of like the explicit ownership model. They are like, I explicitly want this, blah, 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 blah. And again, it's not wrong, but if you're going to do it, you got to go all in. Conversely, my whole strategy has always been implicit control. And that's kind of ironic, I suppose. It's just, I don't think about ownership percentages. I think about optionality. And so as I think about constructing a portfolio, we've always said, I don't think we're deal pickers. We have to be portfolio constructors. So as I think about constructing a portfolio, I see the first bet as the option. It gives you the option to sit at the table and be at the table for the second round. And generally speaking, I find that I make my highest multiples in terms of dollars on my first check, but I make my highest cash on cash returns on the subsequent checks. And that's where you get into the internal rate of return calculations that you're talking about, which are really the easiest proxy to determine whether or not you're being successful as an investor before any of the returns show up. So now that I've said all that, I guess what I would say is that, for individual investors like you and me, I'm not alarmed by this new seemingly new strategy by, YC companies. But if I was sitting here and thinking about how to get into those companies, I would be thinking about it as an index approach. Like, can I find a early stage manager that has a YC index fund that can get small slivers of multiple companies per batch? I'd almost rather just get in as a small LP into that, get the optionality through the reporting that I get back from that GP, and then determine if I want to invest directly or if I can invest directly in subsequent rounds. Full disclosure though, at this stage of my life, I'm just not interested in that. It just seems like Y Combinator is making it really hard for people like me to want to get on a plane and go out there and meet those companies. Not because they're bad companies, but where I'm at in my life right now, I got a bunch of kids and a business, all that stuff. It's like, 10 years ago, yeah, I'd be all over that. I would totally do that, So let me pause there.
Yeah, I think what you mentioned about the largest return on your cash on cash portion on those later checks. I think that's the part that I haven't fully modeled out when I think about these earlier exits. You and I had some conversations offline last week about a portfolio company that is raising, and that I asked for your advice about what we should do, and the multiples on what we have invested in that company are what I would call decent, but it also comes back to this. So probably the best way to enunciate this is to talk about one of the companies that we have an investment in, and that's Data Robot. We have an investment in Data Robot from a Techstars seed fund back in 2011, 2012. And for folks that don't know Data Robot, they're a big data warehousing AI company. They do their biggest client is Snowflake, which is a large publicly held company. And Data Robot's internal valuations are quite high at the moment, and barring something drastic, we'll exit as one of the unicorns in our portfolio. And so it's sort of like, okay, well, if I were to start exiting some other companies earlier, does that, the thought in my head when you and I talk is like, all right, am I going to miss the next unicorn? And so if I try to translate that to this discussion about companies exiting earlier, if they are exiting earlier by their choice, not ours, does that further reduce the already small percentage that you find a unicorn if X% of your portfolio doesn't plan to exit in that fashion? And to your point, I think at first blush, I feel like that means that we need to write more smaller checks to increase the size of the field. But I'm not sure how that changes things for how I might write, future round checks. But I think, to your point of indexing, if I could do that without carry, or with the right amount of carry, then yes, I would absolutely want to be spread out amongst more companies, because I think I'm going to need maybe not significantly, but noticeably more total companies to find the next unicorn, percentage wise.
I think so. I could take this particular part of the conversation in a couple different ways, but let me just kind of start again with a disclaimer. Like, there's not, I tend to speak very assertively, but I don't mean to suggest that my way is the only way. The key idea I just want to put in front of this, what I'm about to say, is that,
oh, come on, you have this phrase, man. You said it so many times on the Tech Tour. Come on, drop it for me. You have strong opinions that are loosely held.
Correct. Yeah. So here's the bottom line. Like, I am unapologetic about being a capitalist. And the thing is, though, is that I want to address something you said directly there. Like you said, maybe we should do more or whatever. I actually think that is correct. But the caveat or the nuance there is I think that you should probably at some point, if you haven't already, write down the thesis. And the thesis is not
Right.
hey, when you're sitting there fresh on a weekday morning like now, I actually, all joking aside, I think it's after 2 glasses of wine and you kind of let it loose on a napkin, and then you look at it again the next day and say, okay, does this make sense? I don't want to cross any boundaries and get the wrong people looking at me, coming after me. But here's the thing, so when you think about venture returns, and I'm just pulling up my own returns because I track them pretty aggressively. So there's 2 key indicators I look at. Now, making money in this industry is very hard, or I should say it can be very complicated because it's very hard to market and all that stuff. For me, the way I think about it is there's 2 calculations that I care about the most. And I promise I'm going to get to your point here, but let me talk about this first to tie it together. First of all, the most important metric is TVPI. That's the metric, total value paid in. That's basically the cash on cash return. So if you put $1 into a certain asset class, and then let's say you liquidate that whole asset class a certain time later,
Yep.
if you get $2 back, that's a 2x TVPI, right? And then in between those 2 events, a lot of days, weeks, months, or years can go by where there's no liquidity. So you have no way to measure true TVPI. You can't touch the cash. You can't pay your mortgage or whatever. So in the interim, though, you got to track IRR, internal rate of return.
Right.
It's messy. It's kind of weird and loosey-goosey, but it's the least worst way to track the performance of an asset or set of assets until they go. So I've been tracking mine year over year, and I just, as an individual investor, I don't have funds anymore. My last venture fund was in 2014. After that, I started moving into just grouping each year of my investments into what I call year 1, year 2, year 3. It's just a loose way for me to measure it. So in other words, if I invested in a company in 2016 or 2017, and let's say then I had to do a follow-on round,
Right.
that money, let's just say the follow-on round was today, I would actually include that calculation back in that particular year's IRR and TVPI calculations, that just like a venture fund would.
Hmm.
All right, so high level, I am returning somewhere between, so let's see, some of the older years or vintages are returning 8.2x TVPI net. That's net. So that's after all my legal fees, right? That same particular year, for example, the IRR of the unrealized gains is sitting at 21.9%. The next year after that, net TVPI is 5.1x. So I've returned 5x of that money already to myself. And the net IRR of the unrealized gains is 17.4%. And so the point is, I don't say that to show off to anybody, but the point is to now come back to what you just said there about, you said something like maybe, I think you were thinking out loud, like maybe we should do X, maybe we should do Y. I think the answer to all those things is probably yes, but it starts with sort of a thesis, and then we can kind of build backwards on the math. And so, for example, one of the things you've said very recently that I think is the first time I've heard you talk like this is you've said, I'm going to do 10 investments in the travel space.
Right.
Now, personally, I think the number should be at least 20. Realistically, it should be 30. Now, you can distribute that over the course of a number of years. It doesn't have to be within one calendar year.
Well, just to clarify, as we talked in the show, we want to do 10 investments a year for 5 years.
Love it. Okay, so there's 50 right there. That's perfect because if you run the Monte Carlo simulations on that, your risk of total catastrophic loss of those funds drops to under 5% once you get past 23 investments. As long as there is a consistent set of discipline in terms of initial checks and follow-on rounds. So for example, my thesis is like, I generally don't want to be more than 20% of anybody's round.
Right.
That's like on the high end, like on the upper end of the bracket. On the other side of it, I really also don't want to be less than a 25K check. It's just hard to kind of get out of bed to do that work for that. But I really just want to get into the first round. And I just want to get to know the company, see how it's going. And then where I really want to start dialing up is in that second round, third round, fourth round. And that's sort of like my generic model. I'd be happy to model it out or put it on a spreadsheet for you or any of the listeners. But I want to end this little ramble of mine by just reminding everybody that I'm not suggesting my way is the right way, but I do wholeheartely believe that you've got to pick a strategy and then execute on it and stick to it. Because that has worked really well for me over the last 10, 15 years. And I think more people could copy it. I don't think I'm unique in that sense. I think more people could copy it. So let me pause there.
The only thing I'd say that I disagree with, disagree is probably the wrong word. I don't disagree that you absolutely need to have an investing thesis, and that the prolific nature of the number of checks that we have to write is a key part of reducing the variance in these high risk, high reward investments. What I would say is that I think with this evolution of companies moving towards trying to find their way towards profitability and or exits more quickly, and this development where it's going to be harder to have a larger part of the company, I feel like I absolutely want to have a set of criteria that I'm applying, but I also my wheels are continually turning on. I'm not sure what the right follow-on strategy is going to be.
Well, I think the way to, yeah, that's fair. That's fair. And at some point, maybe at some point, I always hesitate to kind of like open the full kimono publicly, just, family safety, all that stuff, but I'd be happy to walk you through like some of the spreadsheets privately.
Sure.
But because here's the thing, like a lot of venture capital is discussed as a black and white binary outcome kind of thing. So you'll hear people say things like, and I've said it too sometimes, where it's like 99% of your portfolio is going to go to zero, and then that last 1% is going to return 40x or something, right?
Right.
That's a great tweet, but the reality actually in my model, if you look at the distribution profiles of these returns, is that let's call it 90% get written off. Let's say 90 to 99, that next 9% are like 3 to 5x returns. You're not excited, but you're not sad, and they kind of help offset all the losses.
Right.
And then that really allows you to then goose that last 1%. Coming back to the YC thing here in a moment, or just for a moment, the most difficult part to me in my model, the reason my model doesn't work very well for that reality that is indicated in that article, is that they're suggesting that the entry price in terms of valuation is somewhere around a $15 million pre. That's what I think they're suggesting.
Yeah.
That is really what makes it difficult right there. If we look at, the publicly reported exits in this country. So just for a moment, I'm not trying to discount the rest of the world, but the fact is like you and I trade in US dollars. We're holding most of our assets in US dollars.
Right.
So by and large, the exits in the United States are what matter to us the most. Even my foreign investments are held in the United States. But the point is, if you create a plot or plot out all the exit values, the reported exit values, you and I both know that they're not always accurate. They're like, clickbait and all that stuff. But if you actually kind of like put all of them onto that distribution chart, right? And you assume that like by putting them all on there, some of the noise comes out. What you find is it's a bell curve. It's a normal distribution with the lower end of the bell curve starting around 20 million and the upper end of the bell curve ending at about 100 million. So what that means is that on average, if there was an exit, you can expect that they're mostly going to happen in that $20 to $100 million range. Certainly things happen after that, but that's long tail, right? So that's where the entry price really matters. I publicly don't talk about this very often, but it gets very difficult to make my model work if the entry price is north of 5 million. I mean, I have done deals. I mean, even the one we're doing now, I think that one's at 6 maybe, and it's like, it's not the end of the world. And, you can get fuzzy around that 5, but when you get into like $15 million starting points, oh man, I don't know. Like it just doesn't, that gets really difficult, particularly given that there's so many other companies available that are equally as ambitious and may not have the pedigree, or they may not be at a point in their life where they can pick up and move to Palo Alto, and be there for 9 weeks or 12 weeks or whatever it is. So I know I'm going long on this topic, but I genuinely do believe that investing in entrepreneurial founders is a very viable way to generate an extreme amount of wealth, as long as you kind of manage the risks carefully.
Yeah. I think the thing that keeps rolling around inside my head is, I would say, like, if I looked at my and my partner's investing history over yours, I would guess that you invested in later rounds at a higher percentage than we did. And when I think about, in an absolute world where every deal now follows this new model that we're talking about, where, entry points are higher, exit points are lower, I think a couple of things. I think and they're related for sure. I think we probably follow on more frequently because from a cash on cash standpoint, it's going to be easier to get a return on our quote unquote final check into a company if they're exiting at these lower exit points. Because as like a company goes, maybe they raise their first round. Well, we use the 15 million that's in the YC example here. They're raising their first round at 15. Maybe they're raising the next round at 35 or 40, and then maybe they're raising the next round at 70, 80, 90. And then at some point that starts to compress, and the multiple of growth on the company goes down a bit just because the numbers get so big. Like if you have a $1 billion company, it's hard to turn a $1 billion company into a $10 billion company. And it's hard to turn a $10 billion company into a $100 billion company. So If if this path continues and holds, and the exits are sooner, then that should increase the chances that you're going to get a good return on the last check into the company.
Yeah.
So,
Yeah.
but you just have to hit more. You have to find more winners.
Well, you know, this part of the conversation is hard to talk about because as something that I believe that I think a lot of other investors disagree with me on is that a lot of other investors believe that the early stage market is unevenly distributed, meaning
Yep.
they'll say things like, oh, Silicon Valley companies are too expensive, so that's why I invest in my area in the Midwest or wherever. The truth is, it's counterintuitive. The truth is that at the early stage, valuations are generally pretty normalized. In other words, there's enough transparency now in the market that you might get lucky getting into a deal more cheaply, somewhere else. But the reality is there's so much transparency in the early stage market thanks to things like AngelList and all these other platforms now. So early stage valuations are relatively normalized now. Where it gets really counterintuitively tricky is in the later stage because there has not been an explosion in new players in the later stage rounds. So a Series E for Twilio looked very different than a Series E for Rubrik.
Sure.
Both of those companies went public as well. So I think the way I think about this is that we are aggressive in our second check and maybe our third check, but after that we move to just hold pro rata only.
Right.
Because of what you just described, because the cash on cash return possibilities for me sort of flatten out when I'm fighting against people that are much more sophisticated from a financial standpoint,
Sure. Yeah.
At that point, I'm just hanging on tight for the ride. That first check giving me the optionality to at least exercise my pro rata at, let's say, the Series A, and then at least give me the option to call the founder and say, hey man, if anybody else isn't taking their pro rata, can I take it? Like I'll do things like that through that Series A and B. I don't know what you name things anymore, but the point is I get aggressive about buying up in that second and third check. But beyond that, I'm kind of just holding on tight with pro rata as much as I can. And what makes this really, really difficult, as you know, is that you just can't time the exit.
Right.
You and I were trading text messages about Wealthfront's new automated bond ladders.
Right.
And putting aside the flexibility and the fees of that and all that, it's fairly predictable.
Sure.
I can buy a 6-month term, a 12-month term. I can market to market and know when I'm going to get my liquidity. But with private market investing, that's the most difficult part is really just kind of figuring out how to accept the large variance there might be in hold times. So
yeah,
it's funny to me. I find this topic to be one of the few topics that I've been really interested in talking about for the last 15 or 20 years. I find that ironic too, because it's also the topic that stresses me out the most.
Yeah.
But I've loved it. But I am at a point in my life now, I'm 43 and my kids are getting older and I like traveling for fun now instead of chasing every deal. And so I am reallocating my own portfolio as liquidity comes.
Yeah.
But if I was 10 years younger, 15 years younger, no kids, man, I'd still be playing this game hard. I still think it's really worth it.
Yeah. Well, I think that's a good place to land the plane, my friend. I'm going to get on one of those later today and head home. And the next time, when this episode drops, actually, I will be in a different sort of hell. I will be in Orlando trying to figure out how it feels to be disgustingly hot and have insane humidity levels at Disney World.
Are you doing Disney in May or June? What are we? I don't even know where
we're in June. Yeah, just want to let you know. Yeah, we're going to do it in June. But we're in the middle of the day. We will either be in the pool or in the hotel room. So.
Well, I guess I'm not that much smarter. I'm doing Disney at the end of August, which is probably not the smartest time to go, but at the same time, with all the kids starting to get older, all their camp dates and school dates are starting to not line up right now. So
yeah.
So anyway, we'll see. It's gonna be a hot time of the year. But maybe for those of you watching on YouTube next week, we will get a glistening poolside Ed for the video.
There you go. Yep. And we'll have one more view because Paul will be logging on to see what he said about PointsBet.
It's bad that I have to go to my own YouTube show to figure out what I said last week.
Nah, we can use a click. We can use the click.
I love it.
All right, man.
I'll talk to you soon. Safe travels.
Thanks.